So you saved up some money and now you're looking to make it grow. You've probably heard about investing, but you don't know where to start. 5 years ago, I didn't know either. But after years of research, I figured out the easiest and simple way for most people to invest, and I want to share that with you today. I am living proof that this works, and it's also backed by the most famous investor of all time, Warren Buffett. This is also how I turned my portfolio from $0 4 years ago into over $600,000 right now, and I'm going to explain to you my entire process in a way that everyone can understand. I also have a bonus towards the end of the video of me making a live trade so that you can make sure that you're doing it the correct way. The key to investing is about putting your money to work, but if you're new to this, the world of investing can seem like a maze with all this jargon like bull market, bear market, ETFs, index funds, limit orders, ticker symbols, the S&P 500, the NASDAQ, and the list goes on. But here's the good news. Investing does not have to be complicated, and I'm going to simplify it for you. In this video, I'm going to break down why you should invest, how to get started, what you should invest in, with all easy to understand terms and lingo. We'll also cover some of the basic strategies for beginners and address common questions, plus a live demonstration of me making a trade. So if you're ready to dive into the world of investing, grab a drink, sit back, and let's get started. So coming off the top, why should you invest? Simply put, the goal of investing is to make your money work for you. Keeping your money in a savings account like a big bank like Chase or Wells Fargo might earn you 3% interest a year. But what if it's possible to reliably earn 10% every year in the long haul? Luckily for us, this is possible and it's pretty easy to do, and I'm going to explain to you exactly how we do that in just a minute. But before that, we need to talk about the magic of compound interest. So compound interest is the interest you earn on your previous interest. So for example, suppose you invest $1,000 and it makes a 10% return. After the end of the first year, you're gonna have $1,100. And the next year, you earn 10% on $1,100, and the list goes on. So over time, the compounding effect can lead to significant growth in your investment. So this demonstrates the power of investing and how it can compound your wealth over time. Another key reason to invest is to protect against inflation, which is a gradual increase in prices over time. The US Federal Reserve aims for about a 2% inflation rate annually, but recent rates have been around 5%. So if your money isn't growing at least as fast as inflation, you're effectively losing purchasing power. So a simple way to see this inflation in action is by looking at the cost of postage stamps in 1971. So a postage stamp in 1971 costed 8 cents, but today it's 73 cents. The service hasn't changed, you're still gonna mail from point A to point B, but inflation has driven up the cost. So this is why investing is crucial to maintaining and growing your wealth. So how do you start investing? So there's many ways to invest, such as buying stocks, real estate, collectibles. For example, if your family bought a house for $100,000 in the 80s, it might be worth $1 million today. That's thanks to real estate appreciation. However, we want to focus on the simple investment that everyone can make right now. That's why we focus on the stock market, which offers a more straightforward and accessible way to grow your wealth over time. So I think one of the best ways to start investing is in index funds, which index funds track a group of stocks like the S&P 500. So the S&P 500 is the top 500 companies in America and has historically done about 10% annually. So as a beginner, you might hear about investing in individual stocks like Coca-Cola, Tesla, Apple, Google, which can be exciting, but it's also volatile and risky. So picking individual stocks requires a lot of research, and that can be stressful, especially for beginners. A more straightforward and less risky approach is to invest in index funds. An index fund is a type of mutual fund that tracks a specific index, such as the S&P 500, which is the top 500 companies, like I already said, in the US. This type of fund is passively managed, meaning it doesn't try to outperform the market, but simply tries to mirror the performance of the index it tracks. This provides broad diversification, which helps spread out the risk and offers a more stable return over time. So the ticker VOO is the Vanguard ETF or index fund that tracks the S&P 500. So investing in an index fund is a great way to gain exposure to the stock market without having to pick individual stocks. So investing is highly specific to the investor. What I mean by that is everyone's goals and risk tolerance is different. For younger investors with a longer term horizon, I like investing in index funds because it allows time to ride out market fluctuations and benefit from the long-term growth of America, because the S&P 500 is the 500 biggest companies in America. So if America grows, that index should go up with it. However, if you're closer to retirement, a lot of people recommend that you do something a little bit more conservative, like maybe a 50% stock, 50% bond portfolio. So that's something to think about of your risk tolerance as you get closer to retirement. But if you're under age 50, I believe that being in the stock market such as the S&P 500 is a great way to grow your wealth. So the next question is, where do I put my money if I say that I want to invest in the S&P 500? Because there's different types of accounts you can use to invest, such as retirement accounts like a 401k, an IRA, or a Roth IRA, or just straight up standard brokerage accounts. So retirement accounts often offer tax advantages, but usually restrict withdrawals until a certain age. Brokerage accounts provide more flexibility, but are subject to taxes on your capital gains that you realize. Popular brokerage firms like Fidelity, Charles Schwab, and Robinhood make it easy to start investing with a user-friendly interface and low or no commissions. Choosing the right type of account depends on your financial goals and tax considerations. So then the next big question is, when should you start investing? So I think that the best time to start investing is as soon as you're financially ready. This means having all high interest debt paid off, establishing an emergency fund for about 6 months of living expenses, and only investing the money you can afford to lose. Now, it doesn't mean you're gonna lose the money that you're investing with, but if you put $20,000 into the stock market and it happens to fall 50% over the next year and you're down to $10,000, but you were planning to use that $20,000 to buy a house with, now you might not be able to buy that house. So it's super important to start early because it gives you more time to benefit from the compound returns and recover from any potential losses that the market makes in the short term. So the goal is to grow your wealth over time. The goal is not to try to get rich overnight, because that is highly, highly risky and you will probably lose everything. We are investing and we will expect to grow our money at roughly 10% annually. So the next question people ask is, how much money should I start with? So there's really no set amount of money to start with, but the key is to begin with what you can afford to invest consistently over time. If you're just starting out and have limited amount of money, it might be better to just invest in yourself, build your skills, start a side hustle, work on increasing your income. But once you have steady income and no high interest rate debt, you have your emergency fund set up, you can set aside a portion of your income to invest in the market. Consistently investing, even with small amounts, can lead to massive returns over time. There's a statistic about Warren Buffett where 90% of his wealth was generated in the last 10 years because the returns that he's making annually is on such a huge number that he's making so much money because it's off of such a bigger number. Versus when he started out, he had 10% off of $10,000, for example. Now he's making 10% on $100 billion. So it's a big difference there. So now we're gonna do a live trading example using Charles Schwab. So we're gonna go to the trade tab. I'm gonna type in the ticker, VOO, and we're gonna buy one share. So when you buy a share, it's always important that you do a market order, because when you do a market order, it's basically gonna execute no matter what. The trade will go through at the current price. It's basically like when you go to a gas station and you buy gas, you're buying gas for the market price. If you do a limit order, it's like going to the gas station and saying, well, the price of gas right now is $3 a gallon. I only want to buy it for $2.90. It might not drop to $2.90, so your trade may never go through. So I recommend market orders and make sure your dividends are reinvested. So just like that, we have the trade done. I make sure that the dividends are reinvested and we're good. So investing is a powerful tool for growing your wealth and securing your financial future. Whether you're a beginner looking to refine your strategy, there's always something new to learn. If you found this video helpful, please share it with your friends, like, subscribe. I make videos every couple days on investing. I'll see you guys later.